Welcome to our tax planning webinar series. It's about that time of year where we all start planning for year end and preparing for the upcoming tax filing season. My name is Laurie Stiles, Marketing Coordinator with HHM CPAs, and I'm joined by John Paul Davis, one of our partners and CPAs at the firm. Would you please introduce yourself?
Absolutely.
Yeah.
So I'm John Paul Davis. I'm a partner with HHM and head of our Management Advisory Services group. Part of what we do for our clients is help high net worth individuals with tax planning and also businesses with tax planning. So one of the things we wanted to do in our webinar series was to talk about some of the topics that from year to year we've seen come up, questions from our clients, especially considering that we're expecting some type of tax law change. It hasn't been finalized yet, and as soon as it is, we're planning another webinar series or another video to at least explore in more detail. But the questions we have planned for this webinar are really questions we've seen year over year, probably just good basics to go over, and questions we've seen from our clients that really, being so close to year end, it's a good idea to just maybe dig in.
Absolutely. Well, let's go ahead and get started with our first question. So, John Paul, what are the major takeaways from the Build Back Better Act in regards to tax planning?
Well, my biggest takeaway is that it's not final yet. So part of the problem is we know there's potential tax law changes. What we saw coming through earlier in the year were possibly dramatic changes, rate changes, increased tax in general for most Americans, most taxpayers. And what we're seeing now in what has passed some layers of Congress and debate has been a much less impactful, yet still specialized and still some tax rate changes. So we'll dig into that. But essentially, the biggest takeaway is it's not final yet. We're not quite sure. Maybe a good way to answer it is we don't expect tax rates to go down. We do expect tax rates to go up next year. At what level, we don't know, and at what income level are most taxpayers affected, we don't know yet.
Yep. Okay. So what are the changes to the federal income tax rate brackets from 2021 to 2022?
Good question. So we were expecting certain changes to the tax rates themselves. Okay, so tax law, there's brackets, they increase. The highest one right now is 37%. Pre-2018, it was 39.6. We were expecting that to perhaps go back and revert to that highest level, but so far it's not. We're not, I don't think right now, and again, I'm going out on a limb because we don't have any final tax law changes, but at this point we're not expecting it to change beyond the current brackets that they are in. Now keep in mind, the amounts per bracket do change annually for inflation, right? So just tracking with changes of the purchasing power of the dollar, the bracket levels themselves will increase, but the rates are the same.
Okay, well that's helpful. So while keeping the proposed surcharges in mind, how can taxpayers minimize their tax liability?
Yeah, and let's dive into that question just for a second, because some of our viewers might not know that the Build Back Better Act proposes certain surcharges. And what's a surcharge? It's essentially an added layer of tax or an extra percentage once income hits a certain threshold, right? So what's happening is those income levels are so high, 5 million for married filing separately, 10 million for married filing joint, that for the most part, a lot of our clients aren't necessarily seeing a surcharge unless they have maybe a liquidity event, sold a business, and the enterprise value is greater than 10 million. So in that year, they could have increased tax, or rather, excuse me, increased income that then hits a surcharge. So items to plan, for instance, perhaps save some deductions for the following year. There's some items to do to consider, or maybe there's ways to structure your transaction. Maybe if you have a note, you can spread out some of those gains over time instead of recognizing it all in one year. The important thing is to realize once it's finalized what the level is. When does the surcharge come into play, into effect? What type of income is it? Okay, and then plan for, okay, what pieces can we move? What can we do? And really, it's working with your CPA to come up with a good plan.
Right. That's when the strategy of the tax planning comes
Exactly.
into play.
Exactly.
Okay. So what are some things to consider when it comes to retirement plan contributions? It's never too early to start thinking about that.
That's right. And so, you know, some plans allow for contributions up to the date of the filing of the tax return for the previous tax year, right? So, you know, if on April 15th you haven't made a 2021 employee, retirement plan contribution, you could potentially make it, depending on the plan you have, by the time you file your tax return in 2022. Okay? The important thing is check with your financial advisor, make sure you know the type of plan you have, or potentially create the plan before the end of the year so that you can contribute into it. You might not have to contribute, but at least you've created the vehicle to do it.
Okay.
Importantly, just work with your CPA, your advisor, and also your financial planner to make sure you have the tools in place or the account in place that you can get the benefit on your 2021 tax return.
Great. And that's why it's important to have a team around you.
Exactly right. And it's not just one person.
Right.
You know, the best way to do it is to really have a team of individuals that are giving you the advice that you can look to.
That's great. Great. So are there any state and local tax considerations?
Yeah, good acronym for that is SALT, right? Every accountant likes a good acronym.
Yes.
So SALT considerations, a lot of us have seen this as the debate around the cap on tax on your individual tax return. So that cap was $10,000, and that's been in place for a few years. A lot of that was state income tax, real estate tax, all of that added to various buckets. If it was greater than $10,000, it was disallowed as a deduction on the personal return. Several states have taken strategies to allow for deductions by allowing businesses, which for the most part, a lot of pass-through businesses don't pay tax, but states are allowing those pass-through businesses to pay the tax so that the individuals, whether they're capped out or not at the individual level, get a deduction. And the deduction would be on the business return that then flows through to the individual. Long story short, what am I getting at? So basically, work with your accountant to make sure that we're taking the right strategy when you file your return to give you the deduction on your personal return, whether that's having the entity pay it or finding ways to do it at a state level.
Okay.
And again, different by state. Some states
Right.
allow it. A lot of states are having plans to allow for it. So it's really a state-by-state consideration.
Okay. So what are most clients' tax liabilities looking like? Are there any trends that we're seeing this year?
Yeah, so for the most part, throughout the economy, 2021 has generally been a good year. Certain industries, like automotive, have had great years. But that said, there are certain items that we've used as planning and clients have used as planning that this year is a little bit more complicated. For instance, LIFO, last in, first out, inventory cost flow method that allows for deferral of income as long as prices are increasing. Well, right now, our dealers have less inventory than they've had at any point, probably. And so those deferral mechanisms that we've used, like LIFO or accrual to cash conversions, tend to be reversing. Okay, so what we're working with our clients on is, have you had any timing differences that you've taken advantage of that are reversing this year, and so we have extra income? It's really phantom income. We generated profit in prior year, moved the income to a different year, and now we're having to recognize it. So a lot of it is looking at, did you meet safe harbor? Easy consideration, eliminate underpayment penalties and interest. Look at that through withholdings. Did you make your quarterly estimated tax payments throughout the year? You look at reversal of timing differences. As far as the trend goes, overall, the trend is higher income means higher tax.
Yeah.
And how do we account for that? How do we plan for that? Because on a level, you can go out. What I like to tell my clients is, don't spend $1 to save 40 cents, okay? But if you're planning on making a purchase, if you're planning on making a purchase on January 2nd, okay, you might want to consider making that in December, placing that assets in service, potentially getting some accelerated depreciation. Now, couch that with, if you're, remember in our previous question, those surcharges. If you're looking like you could be at the cusp of a surcharge or a rate difference due to your earnings level, then potentially you might want to save that deduction for a higher income tax year. So again, I know I said this a lot throughout this webinar, but you really want to work with your CPA and your advisors to make sure, let's look at it holistically from a larger picture.
Yeah.
Potentially we need those deductions more in 2022. But if we don't, and we're in a similar bracket, let's go ahead and accelerate it. Time value of money, I'd rather you keep the money than pay it in before you need to.
Okay. Well, it's a lot of great information, and I think as we've discussed today, there's a lot of opportunities and a lot of strategies that can come into play with tax planning. So I really appreciate your time in joining me today.
Absolutely. And remember, this is really high level. Some
Yes.
of these more salient questions we've seen from our clients from time to time. We will go in greater depth once we really have a good idea as to what's been passed. But right now, just remember, plan for taxes. There are certain things that you need to do before the end of the year that are too late to do, like potentially create a retirement account. So reach out to your advisor, reach out to us, and we'd be happy to answer any questions.
Absolutely. And stay tuned for our next episode in our webinar series. And thank you for joining us today.
Thank you.